If there's one thing the average retail investor is known for, it's chasing bubbles. Time and time again, we see this with cannabis, crypto, electric vehicles. Yeah, I could list out these trends all day long. But in this video, we're going to talk about the next emerging bubble in the stock market, artificial intelligence, and why you might want to think twice before joining in on the fun. Now, think of these situations like when you were young in school playing musical chairs. Everyone's having a great time, the adrenaline's pumping as you dance around the circle. But once the music stops, most of the time, it's the retail investors that are left holding the bag. This is the biggest mistake that investors like ourselves make, chasing hot trends or new sectors, and this is why the average retail investor vastly underperforms the stock market indexes. From 1998 to 2017, the average investor had an annualized return of just 2.6%, compared to 7.2% from the S&P 500. So, as everyone on the internet knows at this point, all the hype around AI was brought on by the popularity of ChatGPT, which has shown the world just how advanced AI has become. Kids are using it to cheat on their math homework. Hollywood writers are currently on strike over getting paid through streaming, but another concern they have is getting replaced by AI. So the potential of artificial intelligence to disrupt a variety of industries is very real. But you'll notice something during every stock market bubble, like this one. People aren't going to consider the viability of what they're buying into. Think about it. ChatGPT is interesting and all, but how long will it be before programs like this are actually commercialized? How long will it be before there's an actual economic output being created by the new AI companies that are destined to emerge from this bubble? Or if there are revenues coming in the case of ChatGPT, OpenAI is building out subscription plans, so there is potential for profitability there already. That leads us to the next question, which is valuation. With cannabis, you had companies like Tilray getting bid up thousands of percent only to crash when investors realized the actual profit was years away, if ever. It's been 5 years since that mania that happened in cannabis, and the company still isn't close to being profitable. Or the new electric vehicle companies like Rivian, Lucid, you name it. This is a consistent trend you see after every one of these sectors gets hot. Massive IPOs, and in the case of crypto, people are actually calling you stupid and poor if you aren't in on it. So you're already witnessing the same events play out again. We've seen it happening with companies like C3.ai. Now, I guarantee you, most of the people buying this company right now, they don't even know what they do. They're just buying the company because it has AI as a ticker. The stock is up nearly 300% since December, and as I'm recording this video, we're seeing the reality of the situation start to dawn on investors, slowly but surely. That hype doesn't really translate to results for some of these companies. The stock is down 22% after hours, as C3.ai provided revenue guidance for the fiscal year that fell short of analyst estimates. They were predicting sales of around 307 million when analysts had 317 million. So now the stock is tanking. So that's just a small glimpse of what the investors chasing these stocks are in for. Now, the two real darlings of this bubble so far have been AMD and Nvidia. Now, everyone is mentioning Nvidia. I can't scroll for 10 seconds on Twitter without seeing a post about Nvidia. Now, at least in comparison to some of the other bubbles, these companies actually make money, and they have good business models. But the valuations are getting out of hand already. AMD is trading at a PE of 510, but at least the price of sales is around 9, which is still really high, but at least it's comparable to Tesla. So, okay, I can see it. But look at Nvidia, the stock everyone's talking about. PE of 207 and a price to sales ratio of 38. Now, come on. We've seen the company's management team make some good decisions out of this, actually, because of this rally in their stock price. The company just filed a $10 billion shelf offering so they can sell stock into this mania. Smart move by management here. But this just plays back into the point of the video. Retail investors are going to get rug pulled yet again in another stock. Now look, if you bought C3.ai around $10 to $15 per share, if you bought Nvidia at around 150 or 100, congratulations. But otherwise, you're playing an incredibly dangerous game. If you invest now, you're chasing unsustainable valuations, hoping that someone else will be even more of a fool than you, because they'll have to buy at an even worse valuation for you to make any money at this point. These things may outperform longer than expected. I may make this video and Nvidia climbs another 100% from here. Who knows? But that's kind of the problem. No one really knows. You're chasing gains that are more likely than not already been made. Instead, you wanted to be the person who already owned Nvidia for months now, at least. Not the guy buying today after the stock has nearly tripled in price. I strongly advise against investing in any sector that everyone's talking about. Whatever is getting news coverage, the trends your aunt is talking about at the dinner table. If a stock is getting coverage on CNBC, then you probably shouldn't be buying it. You need to spend your time predicting what the next mania is going to be, not following what has already been. As Rick Roll says, you'll either be a contrarian or you'll be a victim. And that's exactly what I make videos about on this channel. ESG-related microcap stocks that have the potential to grow exponentially over the next decade, all while being ignored by the broader stock market. So if you'd like to see more content about some of the stocks I own, I'll link the introductory videos I made on those companies in the description below. Thanks for watching.